What if I told you the biggest stock market crash of this decade might already be happening, and we're just watching it in slow motion? June 2025 isn't just another red month in the markets. It's a coded message, a warning, a financial fault line starting to crack. Global indices are twitching, big investors are shifting quietly, and the media? Still whispering, "Don't worry." But we did the digging. And what we found will change how you see the market from this moment on. This video will decode every major signal from June 2025. Stock trends, economic shifts, secret sell-offs, and potential black swan events you aren't hearing about yet. Stay till the end, because this isn't about fear. It's about why not being the last one left holding the bag. What's happening right now? Let's get straight to the point. June 2025 has been brutal.
India's Sensex dropped over 2,300 points and Nifty fell below 24,800, a level not seen in months.
Banking and IT stocks, major drivers of the bull run, are in retreat. HDFC Bank, Axis, TCS, Infosys. Down globally, the pain is worse. In the US, the NASDAQ has lost over 7% in just 10 days. P500 is bleeding and Dow Jones is jittery, even after months of stability. And then there's the real story, hidden in plain sight. Big investors, hedge funds, and institutions have started moving out quietly. They're not making noise, but you can see it in the volume, the open interest, the liquidity flow. The market isn't panicking, yet, but it's trembling. And that's more dangerous. There isn't just one reason. There are 5 critical forces hitting the global economy at once. Sticky inflation. Despite efforts from central banks, inflation just won't cool down. Food prices are up. Oil is back above $100 a barrel. Core inflation is stubborn. This kills consumer sentiment and slams corporate earnings. Interest rates aren't coming down, the Fed holding tight. The RBI also cautious. Lower rates, cheap money, stock market growth. But right now, credit is expensive when the economy is slowing. AI tech bubble signals AI stocks soared in early 2024. But now, they're overheating. Valuations are insane. Earnings are weak. Remember 2000? .com vibes are back, just with cooler names and chatbots. Global geopolitical uncertainty. Russia-Ukraine is still unresolved. China's economy is slowing down. Middle East tensions rising. Markets hate uncertainty. And we've got plenty. Credit crisis brewing, defaults are rising. Credit card delinquencies in the US are at a 10-year high. Real estate loans in India are starting to show stress.
And let's not forget, if credit freezes, the economy freezes.
Now let's look at the CASA real indicators. Not just headlines. Corporate earnings. Many companies are beating EPS, but missing revenue. That's a red flag. It means they're cutting costs, not growing. FII-DII activity. Foreign institutional investors have pulled out billions in June. Domestic investors are trying to support the market, but cracks are showing. Bond yields, US 10-year yields are spiking. That means investors are dumping bonds. They expect even higher rates. Not good for equity. Volatility index VIX, India VIX and US VIX are both up. Fear is rising, even if no one's saying it. This isn't noise. This is the orchestra tuning before a crash. The smartest investors don't wait for panic. They buy position before it hits. And here's what they're doing. Rotating out of mid and small cap stocks moves into cash and bonds. Hedging portfolios using options and short positions. Cutting exposure to high PE tech and speculative sectors. Accumulating gold and US treasuries quietly. Warren Buffett recently increased cash reserves at Berkshire Hathaway to record highs. Ray Dalio is talking about a paradigm shift. That should tell you everything. Retail investors, meanwhile, still chasing the next breakout. Let's take a step back. History doesn't repeat, but it rhymes. In 2008, cracks began showing in early summer. Markets didn't crash immediately and they slid, recovered slightly and then collapsed. In 2000, .com mania peaked in March, but the real crash began in the second half of the year. Guess what? June 2025 looks eerily similar. High optimism, weak fundamentals, overvalued tech, rising rates, silent exits by institutions. You don't need to panic, but you do need to prepare. Here's the most important part. How do you survive and thrive in this market? 1. Reassess your portfolio. Are you holding high-risk, low-profit stocks? Now's the time to trim. 2. Build cash buffers. Cash gives you flexibility. Crashes, more opportunities. Only if you have cash when it happens. 3. Hedge if you know how. Learn basic option strategies. Protect your downside. 4. Diversify globally. Consider ETFs, US stocks, or safer assets outside your domestic market. 5. Watch economic data like a hawk. Track inflation, GDP, unemployment, and bond yields weekly. And most importantly, keep learning. The more you know, the less you fear. Look, no one can predict the exact day a crash will hit, but markets don't fall off cliffs out of nowhere. They show signs. They whisper warnings. They give you chances to prepare. June 2025 is one of those warnings. This isn't about doom. It's about data. And if you've watched this far, you're already smarter than 90% of investors. Hit the like button if you found value. Share this with someone who's still blindly buying dips. And subscribe to FinFlix, because in the world of money, information is your best investment. FinFlix, making sense of money. Subscribe, stay ahead, stay smart.